Have you ever stopped to think about what keeps a business from, just falling apart from the inside? Well, today, we're going to pull back the curtain on the hidden systems that protect companies from one of their biggest threats, their own employees. We're diving deep into workplace fraud and the amazing systems built to stop it. Let's get into it.
Okay, so let's kick things off with a number that might just change how you look at your favorite restaurant. Get this. The National Restaurant Association estimates that a whopping 75% of inventory theft is done by the staff. Yeah, that's not customers, it's not suppliers, it's the people working there. That is a huge number, and it really makes you wonder, why? Why would someone who is, for all intents and purposes, a good, law-abiding person, someone you'd probably trust, end up committing a serious crime at work? That is the big question we are going to tackle in this explainer. And it's a story that involves psychology, complex systems, and some of the biggest scandals in business history. So here's the plan. First, we're going to get into the why with something called the fraud triangle. Then we'll look at how companies fight back with their defense, internal controls. We'll see what happens when those defenses fail, spectacularly, leading to a major scandal and a new law. After that, we'll see how this works on the ground with cash. And finally, we'll talk about who is ultimately responsible for all of it.
All right, first up, let's get inside the head of someone who commits fraud. To really get a grip on this, we have to understand the motivation. And for that, we're going to look at a classic model from criminology.
And here it is, the fraud triangle. It was created by a criminologist named Donald Cressy. He studied people who embezzled from banks and found something fascinating. They weren't career criminals. They were normal people who had what he called a non-shareable financial problem. Basically, a money issue so embarrassing or serious they felt they couldn't tell anyone, and crime felt like the only way out.
So, this triangle has three sides, and you need all three for fraud to happen. First, you've got the incentive or pressure. Maybe it's gambling debts, medical bills, or just wanting to live a lifestyle you can't afford. Second, there's opportunity, which is the weak spot in the system. And third, you have rationalization. That little story the person tells themselves, like, the company owes me this, or I'm just borrowing it.
Now, of those three things, the most important one for a business is that perceived opportunity. It's the employee's belief that the company's rules are weak and that they can get away with it. And here's the kicker. It's the only side of the triangle a company can really control. I mean, you can't control your employees' personal life or what they tell themselves, but you absolutely can control their opportunities to commit fraud. And that leads us right to our next point.
So, let's talk about that defense. If opportunity is the open door for fraud, then internal controls are the deadbolts, the security cameras, and the alarm systems designed to keep that door shut and locked. So what are internal controls? Well, put simply, they're the rulebook. They are all the policies and procedures a company sets up to protect its stuff, make sure the business runs right, and, most importantly for us, to slam that door on opportunities for fraud.
I'm going to give you a really simple example. Think about a movie theater, right? They make almost all their money from the concession stand. So what's stopping the teenager at the counter from giving free sodas to all their buddies? You can't have a manager watch every single pour. The secret is a brilliant little internal control. That movie theater puts these key principles into action without you even noticing. You have clear responsibilities. One person works the register. You got proper documentation. The register logs every soda that's sold. And then you have a separation of duties when a manager, at the end of the night, compares the number of cups missing from the storeroom to the number of sodas sold in the register. If 100 cups are gone, but the register says only 90 were sold, Houston, we have a problem. Now, what happens when those controls break down? Take a look at this wild story from the SCIC Cap Credit Union. A single employee stole over $2.5 million over 37 years. How on earth did she do it? She broke all the rules. She was the only one with password access to certain records, and she made sure nobody else ever saw them, by never taking a single vacation day in almost 4 decades. Think about that. A simple rule like mandatory 2-week vacation could have uncovered this decades earlier.
That credit union story is pretty shocking. But now, we're going to scale things way, way up. We're moving from a local credit union to one of the biggest corporate scandals in history. A crime so massive, it literally forced the government to write a new law.
I'm talking, of course, about Enron. Back in the late 90s, Enron was an energy trading giant, an absolute Wall Street darling. But on the inside, it was a house of cards. The top executives were using all sorts of shady accounting schemes to hide billions in debt and make the company seem way more successful than it actually was. It was a total, catastrophic failure of internal controls, right from the very top.
And the result? Absolute disaster. Once the truth started coming out, Enron's stock price just tanked. It fell from a high of about $91 a share to less than a single dollar. Investors, including thousands of Enron employees who had their retirement savings in company stock, were wiped out. Billions and billions of dollars in wealth just gone.
As you can imagine, the public was furious. People lost their life savings. How could something like this even happen? Well, in response to the Enron disaster and a few other scandals around that time, Congress moved fast. In 2002, they passed a huge piece of legislation to make sure this kind of thing could never, ever happen again.
And that law is called the Sarbanes-Oxley Act, usually just called SOX. It's a game changer. It applies to every company whose stock is traded publicly. It forces independent auditors to actually grade and report on a company's internal controls. It created a brand new federal watchdog to oversee the accounting industry, and maybe most importantly, it gave the law some serious teeth. We're talking huge fines and prison sentences of up to 25 years.
So we've talked about the big picture, the massive scandals and the federal laws. But how does this stuff actually work day to day in a regular business? Let's zoom in on the one asset that's hardest to control, plain old cash.
One of the most important tools for controlling cash is something called a bank reconciliation. See, you've always got two records of your cash, what the bank says you have and what your company's books say you have. And because of timing, like a check you wrote that hasn't been cashed yet, they almost never match. A bank reconciliation is just the process of figuring out why they're different. You account for all those little timing differences until, voila, the two numbers match to the penny. It's a super important check to make sure no cash has vanished. And what about for really small stuff? You're not going to write a corporate check every time someone needs to buy stamps or milk for the office kitchen. That's where a petty cash fund comes in. A company just keeps a small set amount of cash in a lockbox. But even this is controlled. Anytime someone takes cash out, they have to put a receipt in. So at any given moment, the cash in the box plus the total on the receipts has to add up perfectly to the original amount. It's simple, but it works.
Okay, so we've looked at the psychology, the systems, the scandals, and the laws. But for our last section, we need to talk about the single most critical piece of the entire puzzle, the people at the top. Look, you can design the most brilliant systems in the world, but they don't mean a thing if the company culture is rotten. It all comes down to what's called the tone at the top. If the leaders of a company act like the rules are just suggestions or something to get around, guess what? The rest of the employees are going to do the exact same thing. But if that leadership team truly values integrity and takes these controls seriously, that attitude flows down through the whole organization.
And the Sarbanes-Oxley Act made sure leaders couldn't just pay lip service to this idea. It made them legally accountable. Section 302 of SOX forces the CEO and the CFO to personally sign their name on the company's financial reports. They have to swear that the numbers are accurate and that they are personally responsible for the internal controls. So that old, "I didn't know what was going on" excuse, it just doesn't fly anymore. The buck really truly stops with them.
So the next time you're swiping your card at the grocery store or buying a movie ticket or even just checking your bank balance online, take a second. Think about all the invisible systems working in the background to make sure that transaction is safe, that the company's numbers are right, and that the opportunity for fraud is locked down tight. It really is the hidden architecture of trust that our entire economy is built on.